Well, hello, folks. It's finally August. It's August 1st. I'm about to head to New York with my family. It's Thursday. We're going to see Lion King, hang out for the weekend, and I'll be back by Sunday night. So you're not going to miss a beat. And I'll be doing reports, videos, and all the other good stuff from New York next few days. So you're not going to miss a beat. We're just going for the weekend. So I hate to say I told you so, but the stock market sold off yesterday, even though the Fed lowered rates a quarter of a basis point. Why did that happen? It happened because the markets were expecting. It was already priced in. There was nothing new here with this quarter point rate drop. Now, markets dropped. Markets were overbought. I'm seeing a little bit more selling pressure, but we may see a bounce today because yesterday we fell off a little more than I expected. I think the Dow went down about 300 points, about 1.7%. So today, big news, jobless claims. It's going to happen in about an hour and 20 minutes. Last week, we had 206,000 jobless claims. We're expecting 210,000, all right? If the number is weaker, if the number is smaller, if there's more people applying for jobless claims, the stock market is going to react, all right? Because if economy is slowing down, remember, Fed said they're not lowering rates anymore. So that silver lining that we had is gone. All right. And that's a shame because I was hoping the Feds would wait till the stock market hit a low point before making this announcement, but they didn't. So now we got to really be careful of the news and information because it's going to have more impact on the stock market because that silver lining that the Fed gave us is gone. So 210,000 is the big number you have to look at today. Again, if we're higher than that, that means economy is a little warmer. If we're a little bit weaker, that means economy is a little weaker. And if the economy is a little weaker, we may see more downside in the stock market because, again, the Fed doesn't have any more things to say, according to them yesterday. They're done. Again, and tomorrow, the big report is the non-farm payroll numbers. Last month, the numbers were 224,000. We're expecting 171,000, which is quite a bit lower. It looks like employment levels are coming off a little bit. Not unexpected considering the time of year. This usually happens in the second quarter. But again, the actual number doesn't matter. It's the estimates in comparison to the actual number. So the estimates are 171. So you have to see whether the number is actually a little bit higher or lower. But the estimate is what you're focused on. Now let's look at the stock market. Let's look at the S&P futures. Now I don't believe actually, according to the numbers, percentage basis, the S&P 500 is about 10% overbought in relationship to the broad market. So even if the S&P itself, which is only 500 stocks, comes off a little bit, it shouldn't have much of an impact because most of the rest of the market hasn't been moving higher. It's been very sideways and choppy. So let's look at the chart real quick, and then I'll let you go with your day. I just want you to make sure that you guys are aware of the jobless claims and the non-farm payroll numbers. Those are huge. So the futures are already bouncing up. We may see a little more sideways. Volatility will definitely increase. We're not going to see this little tight range days that we were seeing as a prelude to the Fed announcement, to the FOMC meeting yesterday. Expect the futures to bounce a little bit higher, but ultimately, I would put a sell stop, or I would put a alert right around the 290.53 level, maybe a little bit lower, maybe around the 290.30 level, because if we break that level, we're going to be going all the way down to the 27.44. There's very little support. We have support at 2,900. That's the number I've been talking about for about 3 weeks now. I do believe we're going to the 2,900 level on the E-mini S&Ps, which would equate to about the 290 level on the SPY ETF. And if we break the 290 level, the next level is right around 285, 2850. But the main level, which one I think we'll see, which is where the 200-day moving average is 2747. And there's a fair chance we'll get there before the market starts coming up. Now, here's what you need to understand. It's healthy for the stock market to do that. If we go down to the 200-day moving average to the 2747 level, the odds are the market will spike back up again. You know why? Because statistically, when the Fed lowers interest rates, there's a statistical chance that the stock market will gain over 16% over the next 12 months. So a pullback is actually very healthy. Please, please, please put an alert around the swing low of yesterday, and again at the right around the 2900 level. And if it gets hit, you would probably be better off in defensive assets, utilities, gold, inverse bond. Let me give you the ticker symbol for that. The TLT, which should be rising a little bit. Yep, because Feds are lowering rates. So again, you may want to start moving into defensive assets. If you see the S&P break down, this is a great defensive asset because investors will flee equities and seek safe haven. And bond market is safe haven. It's called flight to quality. All right, it's Thursday. It's the 1st of August. I'll update you guys tomorrow. I've probably talked more than I intended to, but now you guys know what's inside my head. Talk soon. Take care.